A loan principal is the initial amount of money that is borrowed from a lender before interest and other fees are added. It's the total amount of money that the borrower agrees to repay to the lender over a specific period of time, according to the terms of the loan agreement. The principal amount is typically paid back in installments, which may include both the principal and the interest. As the borrower makes these payments, the principal amount gradually decreases until it is fully repaid. It's important to note that the interest charged on the loan is typically calculated based on the principal amount, so the higher the principal, the more interest the borrower will pay over the life of the loan. The interest rate of a loan is the amount of money charged by the lender to the borrower for the privilege of borrowing money. It is expressed as a percentage of the loan amount and represents the cost of borrowing money. The interest rate is typically set by the lender and depends on a variety of factors, including the borrower's creditworthiness, the type of loan, and the current market conditions. The interest rate determines the amount of interest the borrower will pay over the life of the loan, in addition to the principal amount. A higher interest rate means the borrower will pay more in interest over time, while a lower interest rate means the borrower will pay less. It's important to understand the interest rate when taking out a loan, as it affects the overall cost of the loan and the borrower's ability to repay it. The term of a loan refers to the length of time over which the borrower is expected to repay the loan. It is the agreed period between the lender and borrower for the loan to be repaid in full, and it is usually specified in the loan agreement. The term can range from a few months to several years, depending on the type of loan and the amount borrowed. During the term of the loan, the borrower is required to make regular payments, typically monthly, to repay both the principal and interest. The length of the loan term can have a significant impact on the total amount of interest paid, as a longer term means more interest is paid over time. Shorter terms may result in higher monthly payments, but may also mean paying less in total interest over the life of the loan. It's important to carefully consider the loan term when taking out a loan and to choose a term that aligns with your financial goals and ability to repay the loan. The repayment refers to the process of returning the borrowed money to the lender according to the terms of the loan agreement. This involves making regular payments, typically monthly, that include both the principal amount borrowed and the interest charged by the lender. The repayment schedule is determined by the loan term and can be structured in a variety of ways, such as fixed or variable payments, and with or without a balloon payment. Repayment can be made through a variety of methods, such as automatic debit, check, or online payment. It is important to keep up with the repayment schedule and make payments on time, as failure to do so can result in late fees, penalties, and damage to your credit score. When the loan is fully repaid, the borrower has fulfilled their obligation to the lender, and the loan is considered closed. The collateral is an asset or property that is pledged by a borrower to a lender as security for a loan. If the borrower is unable to repay the loan according to the agreed-upon terms, the lender can take possession of the collateral to recoup their losses. The collateral can be any valuable asset, such as a car, a house, or investments. The type and value of the collateral are usually taken into consideration by the lender when determining the loan amount and interest rate. In some cases, lenders may require collateral for certain types of loans, such as secured loans or mortgages, to minimize the risk of default. However, not all loans require collateral, such as unsecured loans or credit cards, which rely on the borrower's creditworthiness and income to determine eligibility. When taking out a loan that requires collateral, it is important to carefully consider the potential risks of default and to choose collateral that is appropriate and valuable enough to cover the loan amount. A credit score is a numerical rating that represents a person's creditworthiness and financial history. It is based on various factors such as payment history, outstanding debt, credit utilization, length of credit history, and types of credit accounts. Lenders use credit scores to determine a borrower's eligibility for a loan and the interest rate they will offer. A higher credit score generally means that the borrower is less risky to lend to and may qualify for lower interest rates, while a lower credit score indicates higher risk and may result in higher interest rates or loan denials. Credit scores are typically measured on a scale from 300 to 850, with higher scores indicating better creditworthiness. It is important to regularly monitor and maintain a good credit score, as it can affect not only the ability to obtain loans and credit, but also insurance rates, rental applications, and even job opportunities. APR stands for annual percentage rate, and it represents the total cost of borrowing money on an annualized basis, including interest and any other fees or charges associated with the loan. It's expressed as a percentage and is a standardized way of comparing the cost of loans from different lenders. The APR takes into account not only the interest rate, but also any fees charged by the lender, such as origination fees or closing costs. It's important to note that the APR does not include any additional costs that may be incurred, such as late fees or penalties. The APR can vary depending on the type of loan, the lender, and the borrower's creditworthiness. When comparing loan offers, it's important to consider the APR in addition to the interest rate to determine the true cost of borrowing money. A higher APR means higher overall costs and may make the loan more difficult to repay, while a lower APR can result in lower costs and easier repayment terms. A grace period is a period of time after the due date for a loan payment during which the borrower is not charged a late fee or penalty. It is a set amount of time, typically a few days, that allows the borrower to make the payment without incurring any additional charges. The grace period is determined by the lender and is often included in the loan agreement. During the grace period, the borrower can make the payment without penalty and without it being reported to credit bureaus as late. However, if the payment is not made by the end of the grace period, the borrower may be charged a late fee and it may be reported to credit bureaus, which can negatively impact the borrower's credit score. The length of the grace period can vary depending on the type of loan and the lender's policies, so it's important to understand the terms of the loan agreement and to make payments on time to avoid any additional fees or penalties. A prepayment penalty is a fee that may be charged by a lender if a borrower pays off a loan before the end of the agreed-upon term. The prepayment penalty is typically a percentage of the remaining balance of the loan and is intended to compensate the lender for the interest they would have earned had the borrower not paid off the loan early. Prepayment penalties are more commonly associated with mortgages, but can also apply to other types of loans such as car loans or personal loans. Not all loans have prepayment penalties, so it's important to check the terms of the loan agreement to determine if there is a penalty for early repayment. If a loan has a prepayment penalty, it may make it more difficult or expensive for the borrower to refinance the loan or pay it off early, so it's important to factor in this potential cost when considering a loan. Borrowers should carefully weigh the costs and benefits of paying off a loan early before deciding whether to do so. Ultimately, a late fee is a charge that a lender may assess when a borrower fails to make a loan payment on time. A late fee is typically a flat amount or a percentage of the overdue payment and is intended to compensate the lender for the additional costs and administrative expenses associated with late payments. Late fees can vary depending on the lender and the terms of the loan agreement and may be assessed after a certain number of days following the due date. It's important for borrowers to make payments on time to avoid late fees, as they can add up and make it more difficult to repay the loan. In some cases, lenders may also charge additional fees or penalties for repeated late payments or non-payment of the loan. If a borrower is having difficulty making payments, they should contact the lender as soon as possible to discuss possible solutions, such as restructuring the loan or entering into a forbearance or deferment agreement to avoid late fees and other penalties.